G'day everyone, welcome back to Pete's Investing. Today is June 12, 2023. This is the US Canadian dollar currency update. On our weekly, we've broken down into a neutral positioning after being bullish with those couple of big bearish candles on the weekly. And on the daily, we've been in a bearish momentum primarily, so looking at each of these. Okay, we look at the triple moving average of the price chart, combine it with the moving averages of the CCI 150. When they align in the same direction, we go either long or short. Here they're showing, they were showing long in that 1 week there, that then they broke down into a neutrals because they're not aligned properly. So currently neutral, meaning it's uncertain which way to go on the weekly. We use the weekly and a daily to trade the lower time frames like the hourly. On the daily, you can see there it broke above this descending diagonal trend line, and it bounced off this ascending diagonal a number of times and is currently sitting on that diagonal as we speak. If I zoom out, you can see there that diagonal being drawn between those lows and through that area there. There was also this key support at 13226. It hasn't reached that level yet, so we may see a slight bounce there possibly. You can see there's a slight bull candle today, but again we may see this turn into a neutral before turning positive possibly. The other reason I say that is if you go to the hourly, you can see there more closely. There is this, on our last video on that dotted line, we did draw this bullish divergence on the CCI versus a bearish divergence on the price chart. Now that hasn't worked from there, meaning the CCI is still increasing. So this is still in play, although it just extended out further. So as long as the, let me just delete this channel. We did draw this target area there, but that hasn't acted yet. So if we draw this, continue those divergence trend lines, so you can see there the CCI is still trending up and the price chart is still trending down. So that's our latest review of the divergence, which means if we draw a channel now between that level there, actually we don't need the lower level, we just need that level. So it needs actually to go, let me just do that the other way. It needs to go to the highest point, the highest candle in that divergence range. So as long as this CCI keeps moving to the upside, and then the price breaks above there as well, then we're going to have a short-term target. So what we're going to do now is move that Fibonacci range down to that lowest level, which are probably there. So as long as this CCI keeps moving to the upside, and the price, if the price then continues to the upside as well, that means it's playing out, and we're going to have a potential breakout above this channel. That's where you enter if you're trading this. So our initial target would be, again, depends where it comes out. If it comes out here, you can see there it's already in the 23 to the 38% level, but it may take a few more days to play out. It could actually break out somewhere there. So just for the sake of the exercise, I'm going to put a initial target there between the 23 and the 38%, and a secondary target will then be above that between the 38 up to the 50% level. So that may well be, in other words, the price may continue sideways for a while before it breaks out, and that'll be our initial target, and that's our secondary target if it breaks to the upside. And that actually aligns with this descending diagonal line as well if it does that. So that's a possibility. Again, there's no guarantees with this. For the CCI to fail, we need to see the CCI break to the downside, and the price chart also to break to the downside. So in other words, we need to see the CCI trend in the direction of the price continuously for it to fail. So in other words, the CCI fail down and the price to also fail down, in which case our next level of support will be enacted to be looking out for at 13226. So that's in terms of playing the short-term divergence range. But as well, if I zoom out, you can see here I've got this long back test and a short back test. You can see there while the price is moving to the upside, the short back test was returning trades with minimal entries, whereas the average down was occurring. You can see there multiple average downs occurring on the short back test. We don't use stop losses, we use the average down approach. And the way to avoid that averaging down, as I said, and that's why I'm looking at the weekly and a daily, we make sure, in this case, there was no short positions available there. The weekly was primarily long positions. there were a couple of short positions on the daily, so you would have avoided going short in those areas because the weekly wasn't giving you any short signals. So in other words, you would have avoided those short positionings. However, on the long side, you would have traded when the weekly and the daily were long. Actually, you would have taken those long positions. So to understand how to trade this and other trading strategies, reference the links in the description below. Subscribe to my Patreon page where we also do weekly scans of stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching and see you in a future video.